Hello and welcome to the A Plus U podcast, where we chat with our internal experts and community members about how finances affect us in the real world, translating complex subjects to lively discussions, brought to you by Affinity Plus Federal Credit Union. I'm your host, Danielle Johnson.
And I'm your co-host, Amber Shanley.
So Amber was just telling me before we started about she has a mouthful of royalty.
I do. I think that there might be 3 or 4 crowns in there, but the reason we were on that topic is because our guest just left the dentist. And while the dentist is never fun, he said it was fine. And I'm always welcomed back within 2 weeks after my dental appointment. So it's not fair.
Brian, what was your comment? You're not sure what's worse?
My first podcast or the dentist appointment? Yeah.
Well, today, as you heard, we're joined by Brian Volkman. Brian is our CFO here at Affinity Plus. And it's my understanding, Brian, you started with Affinity Plus in Mankato?
Yeah, I started at our on-campus branch in Mankato a long time ago, and I just loved credit unions and Affinity Plus right from day one, and it's been a fantastic journey at Affinity Plus since then. So
did you go to Mankato? Is that how you ended up at our campus branch?
Yeah, so I'm from southern Minnesota, small town outside of Mankato, St. Clair, and went to MSU Mankato for college, and started working there while I was going to school, and it was awesome. It was such a great experience.
So never left.
I never left. Nope. Started on campus and just continued staying here at Affinity Plus.
That's amazing.
I know, because how many campus branches do we have?
7.
So see? One of you listening, you could be CFO one day.
That's right.
From our campus branches. Well, that's awesome. How did you end up as a senior leader here?
So I was in Mankato, and there was a leader of real estate opening was there, and actually Dave, our CEO, he kind of pushed me to apply. He's like, "Hey, you should apply for this," and it was up in the cities, and I was in Mankato at the time, and I was like, "I'll give it a chance, give it a try," and so I applied for the job and got it, and had to relocate it up to the cities, and it was great. So I've led real estate and call centers, lending, a lot of different background at Affinity Plus to get to the CFO role. I went back to school while working and got a master's degree and a master's in finance, which helped me with the CFO side of things. But certainly the branches and lending is a key component of, I think, my role in understanding how our branches work and how it works, working with members. And it's really, I think, makes it well-rounded in the role.
Well, I think just the exposure you've had has allowed you to see all aspects of Affinity Plus. So it's not just making decisions in a bubble. It's really looking at all areas and really looking at the financial impact of each one of those. And everyone plays a different part.
Yeah, for sure. And I think that's, our core value of caring really comes to life. And when you have that branch experience and call center and lending experience and working one-on-one with members, it's really important. And I think it really helps out and translate when you're setting rates on all of our loans that, this is also about the member that's coming in to buy their first home or buy their first car. And it's really neat to make sure we always are thinking about the member that's coming in next or that our employees are helping out with.
Absolutely. And I think that's such a great segue because today we're going to talk about interest rates. And with those, there's it's something we're always hearing about. The Fed is meeting consistently on these, sometimes special sessions, things like that. So back to interest rates and making decisions for our members. How are members impacted by rates? That can't be an easy decision to just set a rate and run for it.
Yeah, so there's a lot that goes into setting interest rates. Obviously, the market rates play a big part of that. The Federal Reserve sets the Fed funds rate, and they set that, and that impacts really its shorter term items. But like mortgages and things like that are affected by longer term rates. So like the 10-year Treasury is not a direct impact from the Fed. And so we really look at, interest rates from the Fed to the 2-year Treasury to the 10-year to say, hey, what should our interest rates be on car loans and mortgages and things like that. So we really set it based on market rates, competitors, things that our members are looking at. There's a lot that goes into setting rates, but the Fed is one everybody hears about, and I think there's sometimes a misperception of that they set the rates for everything, and they really don't. They're really focused on the shorter term rates, and so their impact on like mortgage rates isn't as immediate and isn't as they don't always impact it as much as people think.
So that would be why like rates don't change immediately if the Fed lowers rates.
Yeah. So like credit cards and like home equity line of credits, loans that are like adjustable rate and use the Fed funds rate as that index, if you will, that those are impacted, pretty quick after. But long-term 30-year mortgage rates are generally not correlated directly with the Fed funds rates. You really have to look at like that 10-year Treasury to see where mortgage rates are at in the fluctuations in that rate.
And so that's an example of how you and those around you, I guess, make those rate decisions. And that's why our rates are different than, some other banks or other credit unions. Everybody's a little bit different in their decision making. Is that how that works?
Yeah, I think so. I mean, I think we definitely, try to pay attention to competition. We want to make sure we're offering fair rates to our members on both the loan and the deposit side, managing both of those. But yeah, it's different. Credit unions and banks have different needs at different times as well. And so, you'll see a CD special at one institution, and they're trying to raise deposits and liquidity. And so it's just, each credit union and bank manages their balance sheet and use interest rates to impact that.
Oh, that's interesting, I guess, to put it in that perspective, I guess, for people that don't do what you do every day.
Yeah.
So what role does inflation play on rates?
Yeah, so the Fed really has two main focuses that they focus on, and the first one is inflation and unemployment are the two. So they have kind of a dual mandate. They want to make sure inflation stays around 2% and unemployment is at not zero, but a point where what they consider like full employment, so somewhere around 4%ish. And so if unemployment and inflation are there, they try to keep the interest rate where the economy is humming along, not growing too fast, not growing too slow. And unemployment is in a good spot and inflation's a good spot. And so like in 2022 and 23, when they really increased rates, it was to combat inflation. And so trying to get the economy to slow down, inflation to slow down. And now they started, to slow down and, started to reduce interest rates a little bit, and they see inflation has come down, but they're worried about employment now and economic growth. And so those are the kind of the two balances that they're always trying to figure out is where are we at with inflation, where are we at with employment in the U.S. And so that's always a fine balance with those two. So I think with members that are looking to buy a home or trying to buy your first time home or buy your second home, I think with where, rates are at, they fluctuate all the time. And I think sometimes people, especially now, are like, well, the Fed's going to lower rates and that's what everybody thinks, the Fed's going to keep lowering rates, so I'll wait. Well, the thing is the Fed doesn't directly control mortgage rates. And so, my advice is like you have to look at, home ownership over a long term. People don't usually buy a house to flip it in 1 to 2 or 3 years. You're generally, most people are in their houses for 7 years or 8 years or 10 years. And so you really have to look at it at a much longer term viewpoint. And if you can afford with where rates are at today, I'd say, you're probably better off just going for it. And if rates do come down, you can always refinance, or you can look at like an adjustable rate mortgage. And I think, something that our employees do a phenomenal job with is providing advice to members and helping them, determine what product is best for them, what term is best for them. And I think that's something when you're, thinking about buying a home, if you have some money for a down payment, if you have that, where your affordability is there, I'd definitely, talk with our employees. I think they do such a phenomenal job in helping to provide that advice for members. And even when rates are higher, right? I mean, this is, rates are definitely higher than they've been over the past few years or, 3 or 4 years ago. But at the same time, it's about that affordability. If you can afford it, it's not a bad time. I think, if you look at house prices over 7 to 10 years, you're probably going to be in a pretty good spot.
And we'll have Tara Rutz, who leads our real estate team, on in a couple episodes here. And I believe that she's probably going to mention something very similar, because saving for a down payment and taking that step into home ownership is a big decision. But also what you also said was you can always refinance for a lower rate. And there's not really a reason to be afraid of refinancing. And I think that sometimes when you have a mortgage, it's like, oh my goodness, the cost associated with refinancing, it's going to be the same as when I purchased my house. And that's not necessarily true. And you should always explore different options if you are rate sensitive, but not not having the rate make the decision for you today if you're feeling confident in the home buying.
Yep.
I like that. Would you say the same is true for auto lending? Like if I was looking for a new car today, rates are higher than they were. Same thing with the housing market.
Well, I think rates on car loans are certainly higher today, but I also think it's slowed down demand. So you have a little bit more negotiating power when it comes to the cars that you're buying. There's more vehicles on the lots today than during COVID. It was difficult to find cars, and so there's always balances, right? When rates are higher, not as many cars are being sold, so dealers, have a little bit more of that need to negotiate. And so I definitely think it's similar to that. And, auto loans are much shorter term, so they're 5-year term or 6-year term. So the change in interest rate isn't as significant as it is with a mortgage. When you're talking about a 30-year mortgage versus a 5-year car loan, those changes in interest rates aren't nearly as, impactful when it comes to the payment of your car loan payment or your home payment.
Exactly. And like you said, our employees do such a great job of sharing that difference with members and making sure they're feeling confident in that monthly payment versus just focusing on that rate.
Mm-hmm. Yeah, for sure.
It's the balancing act of payment versus rate.
Mm-hmm. Yep.
Well, we kind of just got through the holiday season, and thinking through like credit cards, you kind of mentioned that was something that can change quickly with Fed rates and everything like that. So maybe kind of speak to credit cards and the interest rates, and maybe kind of the differences between, I know some credit cards are very high interest rates, some are lower, and just like how that can be impactful in someone's finances.
Yeah, so like most credit cards are tied to like the Fed funds rate or, some sort of index, and not always Fed funds. But, so as the Fed lowers rates, your interest rate may go down a little bit, but credit card rates are really high. They can be really high, to start with. So you always have to look at that kind of full picture. And, I think with our credit cards, they're tied to the Fed funds rate. And so as the Fed's lowering rates, those rates start to come down a little bit at a time. And I think our interest rates on our credit cards are very competitive. And so I definitely think if you have a credit card outside of Affinity Plus, you should check Affinity Plus. Even with where rates are at today, our rates are likely lower than others out there. So that's always one. I think there's also, I was looking at balance transfer offers. We do those periodically where you get a lower rate to do a balance transfer. And so those are things that you can do. And so I think credit cards, and I do think, something to, really look at is making sure that your payment is covering, the interest, and you're focusing on your highest rate items when you're repaying things first is always important. It's always good to pay down the highest interest rate, regardless of what it is, first, and kind of maintaining that healthy balance on the card, kind of a good mix, and working to not have your credit cards maxed out. Some of those things will really make a difference in the long run.
Well, I was just kind of thinking, we talked a lot about like mortgages and loans and credit cards, and kind of like on the borrowing side of interest rates and what that looks like for personal finances. But talk a little bit about, if you would, savings accounts, certificates, and kind of how interest rates work in that sense, because I think there might be some people out there who are hesitant to put their money in an account in any financial institution, but kind of how that works with a savings account or a CD where you could maybe make a little bit of money.
Yeah, I think, that's one thing, like, when we were at zero interest rates for a long time, money in a CD or a money market was earning almost nothing. And today, now that, people that are trying to save and savers, you certainly get, additional funds. You can get, 4% CDs and things like that. And that was unheard of a few years ago when, interest rates were at zero. And so I think that now is definitely a time to make sure you're shopping around and looking. And I think our Superior Money Market is a great product for our members. That is a high rate money market with flexibility. So you don't have to keep it in for any length of time. You can move it in and out. It's similar to a savings account. And then our CDs, you lock the money in for 12 months or 18 months, whatever term you're picking, and you can earn a little bit higher interest rate based on the terms. And so those are a good balance. And I think on one of our unique products that we offer is our Wincentive. So it's a product that encourages savings, and for every $25 you save each month, you get entered into a drawing, and to potentially,
I've won.
Yeah, nice. It's great. I think it's a great way to encourage savings, and you still have that opportunity to potentially win. Every month we do drawings, and you see the list of members that win every month and employees that win, and it's cool that it's kind of that rewarding for savings. It's a unique product, and I think one that our members should know about, and it really does encourage that savings, and building those habits I think are really important.
Well, and I think about just the security of keeping your funds in a savings account or a CD versus like mattress money. Mm-hmm. Like you're not earning any interest, on the funds sitting at home in your safe or under the mattress, whatever it may be. But putting it into a savings account or a CD is far more secure, and there's protections for our members and other members at other credit unions, other financials. Can you share a little bit about those as well?
Yeah. So our all of our deposits up to the $250,000 on deposit are insured by the National Credit Union Administration, and no insured funds have ever been lost in a credit union since the 1930s when the NCUA, when the insurance fund was established. And I think that's a really important piece, is that your money on deposit is insured. It is safe and secure spot to have it. It is definitely better than the mattress money, because you can earn interest, and compounding is a really important aspect of it. And so I definitely think those added things like the NCUA insurance are really important for people to understand, and really, an important piece if people from other countries have not had that protections and lost money and things. And so I think, having your money in an insured credit union is a great place to have it.
Absolutely. And I think it's just reinforces what the care and thought that goes into setting those rates. It's to help ensure that members are earning something while their funds are here, but also demonstrating that safety, security. It's like we're paying you to have your funds here.
Mm-hmm. Yeah, for sure.
It's definitely a wonderful piece at Affinity Plus.
Something else I'd also add is, we have the deposits at Affinity Plus are insured, but we also have our investment center that helps members, set up, if you're looking to invest in the long term or set up college funds for your kids. And I think our investment center employees do a nice job of helping to develop an investing plan for our members that is outside of the credit union, so it's not NCUA insured. But I think that is a great opportunity for somebody that's looking to get into investing, or somebody that has a portfolio that just wants to sit down with somebody. And similar to our employees in the branches that help with, somebody wants to buy a home or, wants to buy a car and looking for advice, our employees in the investment center do such a phenomenal job of helping to set up, that long-term view and put people in a great spot.
And we'll help organize your funds. Like, that's the other side of it too. Our investment center doesn't have a minimum to sit down with them. And even if you don't do any business with them, that's okay. It's meeting with someone to establish a plan. It could be referring back to the credit union and structuring CDs and setting a member up for success that way if they don't want to go outside of the credit union. But just the knowledge there alone to ensure that a member is meeting their financial goals is exponentially something that everyone seems to be really excited about.
Yeah.
Well, and I think too, it just goes back to that care and thoughtfulness that we give to members. Like, we have this whole opportunity for you to, sit down with a financial planner who, that's kind of intimidating. Like, mm-hmm. I mean, I think of myself as like, I feel like just like a regular person, and I'm like, I have a financial planner, and someone's like, oh, and I'm like, no, it's not like that. I just want to make sure that I'm like saving properly and that I am going to be able to retire someday. And sometimes my financial advisor, the person I talk to, is just like, you need to do better, or you need to,
spend less on dental.
Yeah. I'll give a plug for Corey Whitcomb at our university office. I just walk into his office at least every other week, and he reminds me that I didn't need Starbucks that day. But I remind him I did, to be a good human.
Well, it's just not meant to be intimidating. It's meant to just like, we can absolutely set you up with some plan for success. And like you said, whether that's go back to on the credit union side and do this, or we can do this here because we don't have minimums. Like, it's just meant to be like people helping people. Mm-hmm. It's meant to be
a trusted
success.
Resource.
Yeah. It's not meant to be something intimidating or scary or fancy. Like, anybody can do it and has access to it.
Mm-hmm.
And I think that's something great about Affinity Plus, right? These are the types of services and things that we offer to our members, and that's what's really important about it, is that our we really strive to have our employees focus on doing the right thing for our members and really focus on, hey, let's do the right thing. And if they're talking to somebody in the investment center and Corey is like, you want to know what, a CD might actually be better for you in this situation for what you're looking for. And I think that's the piece that I really love and appreciate about Affinity Plus is that care that our employees demonstrate, whether it's investment center or real estate employees, they just do such a phenomenal job of looking at that member and figuring out, okay, here's your goals, here's what you're trying to accomplish, and here's what I think is the best plan that I would advise you on. Another thing that I would add is on, interest rates are certainly a very important piece of the payment when you're buying a home or buying a car. But another really, critical thing is your credit score. And, I think really looking at what your credit score is, and our app does a phenomenal job. You can go out and check your credit score. There's what ifs on it. I think really looking at your credit score and like, what are the things that you can do to improve your credit score? Because sometimes moving your credit score from a 650 to a 730 will have more of an impact than the Fed lowering rates 0.25%. And so, I think the like sometimes we look at what the that rate is to buy a home, but your credit is equally as important. So really making sure that you're doing the things, you're keeping your balances on your credit cards lower. There's a lot of really good advice in our app that's personalized to you and tailored to your profile that I think people really should take advantage of, because it's a great way to look at that. That is one way where you can save a lot of money on interest by having an improved credit score and having or keeping your credit score high if it's already high. And so definitely, look at that as balance with interest rates, credit score, and also down payment, right? Down payment is an important piece too. If you're buying a car, if you have a down payment, you're going to get a better interest rate than not having it. And so really thinking about those things are really important when it comes to like what your payment will be for your first home or your second home or your first car, things like that.
That's a great point, because I think we think of interest rates as this big like number or this big concept that we hear about so much, but then there's, it's almost like a tripod, right? It stands on 3 legs, or it's a table, you have 4 legs, and it's not just this one thing that's holding everything up. Mm-hmm.
Well, and I think something that you said too is your credit score is an impact to this, and down payment. Why does that matter? Why does down payment matter?
I think that there's the down payment piece, because if you're buying if your home's $350,000, that's what you're buying it for, a $350,000 mortgage is much different than $300,000, right? And so that the loan to value, kind of that 300 divided by that 350, the lower that is, you might not have private mortgage insurance, and interest rates are generally better the lower your loan to value. And so if you're at 95% loan to value, you're probably going to pay the higher rate. And so that's a really important piece is, that down payment component of whether it's buying a car or buying a home is really important. So that the down payment, the credit score, those pieces are important. And also term, if you do a shorter term, it's generally generally a lower interest rate than if you do a longer term. And so it's always trying to balance those items. But, most people buying a home, you're looking at the 30-year mortgage, because that's the one that's going to provide the most affordability. But it's also, a higher rate than a 20-year or 15-year. And so it's always balancing interests and your payment and your loan to value are really important pieces when looking at that kind of total picture, if you will, of what you're going to be paying each month.
Well, and as you were saying that, I was thinking of a really great resource that we have on the website. We have calculators, and they're very interactive in terms of you can put your term, you can look at the interest rates and say, okay, if I do a 15-year or a 20-year, and you can kind of adjust all that, whether it's a car loan or a mortgage, and you can kind of see how that will all kind of like play out when you're kind of in this state of where am I at, what am I going to do, or just wondering in general if you could afford a new car or a home or something like that.
Yeah, those calculators are very popular, very well used, and our members love them, get lots of good feedback on those. So those are definitely a spot to go out and check and kind of play around, right? Of like what's the loan to value, all of those things matter in it. So those are great tools out there for members.
And you can run that concurrently with the credit score tool that you were talking about with those what if scenarios. So you can feel confident that you're comfortable with the payment, but then what the impact is going to be on your credit score as well, and make a good decision for yourself, but also come in and partner with an employee to help guide you in that decision and ensure you're set up for success the way you want it to be.
Yep, for sure.
Well, Brian, as we wrap up today, what are some final tips and tricks that you have for our members and or just the general public?
Yeah, I think, first and foremost, our employees do such a phenomenal job is reaching out to our employees, like if you're looking for advice and things like that. Our employees do such a great job of understanding your goals and what you're trying to accomplish and helping point you in the right direction with our products and services. And so I definitely think that's a great spot to start. And I think the other one is, if you're buying a car, is like shop around, make sure you're looking at, multiple options and not just taking the first one that you see, and looking at, multiple options is really, really important. And I think, as we talked about before, of like that down payment, the mix of down payment, credit score, and, term, is really looking at those to say, hey, what's that best profile mix for me is important, and making sure that you're, kind of thinking through all the aspects of it. It's not just interest rate. While we're talking about interest rates, that's certainly a very important piece of it. There's other components that go into it. And I think really managing your credit as best as possible is something that's really important as well.
Well, Brian, we really appreciate having you today. You're just a wealth of knowledge. I really hope that this was a little less painful than the dentist.
It definitely was. Yeah. You do a very nice job.
But we definitely, as kind of market trends change and just us as Affinity Plus evolve and change, we'd love to have you back sometime. So the door is always open for you to come visit and give us more of your knowledge.
Yeah, I'd love to come back. This was great. Thank you so much.
Thanks, everyone, for joining us today on A+U. Be sure to follow us wherever you listen to your podcast to continue to learn more about banking and stay up to date with Affinity Plus. To learn more about Affinity Plus, visit us at affinityplus.org.
Affinity Plus is federally insured by the NCUA.